Welcome to Chapter 2 of this section, where we'll discuss interest. In a financial sense, instant gratification, which we discussed in the previous chapter, can sometimes lead to borrowing money to satisfy certain desires, whether this is on your credit card or by taking out a personal loan. When you borrow money, lenders don't just decide to give you the money for free. You have to pay back what you borrow, which is the principal amount, but also something called interest. Interest is a financial incentive you pay someone for letting you borrow their money. It compensates them for not using the money for themselves and for the potential risk that you won't pay them back. In other words, they get something extra in return for letting you borrow their money instead of using it to their own benefit. Interest is calculated as a percentage of the amount borrowed and is generally quoted on a yearly basis. For example, if you borrow $100 at a 20% interest rate on a personal loan, you would pay $20 in interest to your lender after 1 year. Interest can be either paid or received, and you pay interest when you borrow money and you receive interest when you lend it. You can lend money by putting it in a bank account, for example, one that earns interest. We'll touch a little bit more on this later on in the course. The amount of interest you pay on a loan is closely tied to the type of lending product you use to borrow money, as well as your credit history, which indicates how risky of a borrower you are. We're going to have a whole section on debt and credit later in this course, but I want to mention that riskier borrowers are charged higher interest rates because there's a greater chance that they won't pay back what they borrowed. Unfortunately, many people fall in the trap of taking on debt before they understand how interest works. When you accumulate high interest debt, you may actually end up paying more towards interest than the amount you put towards the principal amount. A common example of this is credit cards, which typically charge a very high interest rate. Avoid taking on high interest debt whenever you can. You'll hear me repeat this throughout the course. If you accumulate a lot of high interest debt, the interest payments can become overwhelming, making it nearly impossible to escape the cycle of accumulating more and more debt over time. The balances on your debts may continue to grow over time even if you don't spend more money. This is what interest can do to you and your finances. This is compounding working against you, a concept I'll explain later. To avoid this cycle, you need to understand how interest works before you borrow money. Understanding interest, whether you pay it or receive it, is one of the first steps you can take to have more control over your finances and to start using your money as a tool.